Okay, to keep everybody on schedule, we will get started, and we're waiting for one of our guests to join us. First of all, everybody who's tuned in so far, welcome. Thank you very much for joining us for the next 45 minutes or so. My name is Peter Richards, and I operate Peter Richards Advisory Group, and we've now ventured into almost our 13th year in this industry. And we have built a business that's focusing on helping business families make the most of their wealth. And our experience has, shown us over the past few years that when you build successful, family businesses and wealth, you need deeper planning in how to protect it, how to make the most of your future, and how to transition your wealth to the next generation as effectively as possible. So that leads us to today, October 14th. We want to spend the next 45 minutes with our three esteemed guests and our attendees having good conversation and providing information that hopefully helps you navigate today and into the future when you consider transitioning family wealth. Our theme today is transitioning family wealth. And some of the topics you'll hear about today will be tax strategic ideas, tax savings initiatives, planning ideas that come from some experience, working with, wealthy families across the country, family governance, and also conversation on the next generation and the importance of planning for the future. We encourage questions, if you can today, through the Q&A, and we will try to get to them. It's all about conversation today and after as well. If you think of anything, please send us a note and we'll follow up. As a point of introduction, I'm pleased to have Mr. Greg Toner join us. Greg is a CA here in London, specializing in advanced tax planning strategies, and is working on some very unique and creative ideas for his customers and clients in London. Trevor Parry, who will be joining us hopefully shortly, is a tax lawyer from Hamilton. Trevor has had tremendous experience in Canada dealing with high net worth family planning, and he'll shed some light on some ideas and things that he's seeing today. And of course, Dr. Tom Deans is back joining us after, I guess, a couple of years of hiatus. He was in here a few years ago talking to our friends and clients. Dr. Tom is a best-selling author across the globe. Was a CEO of a family business for many years and has great experience in the topic of family governance and generational wealth, and is currently, I guess, through video speaking all across the globe. So off we go. Greg, we'll start maybe with yourself for 10 or 15 minutes, and I'll lead off with the questions, and guys jump in because you're a wealth of knowledge. What tax strategies are you seeing and trying to implement as a result of the impact of the COVID environment over the last 6 or 7 months?
For sure. What I'm seeing the most, and kind of what the most exciting part is, the opportunistic tax strategies. So this all comes around freezing and transitioning wealth. There are stats thrown around there. I think the biggest number I've seen is 68 trillion. I think that's a worldwide number of wealth that's going to transfer as the boomers retire and die eventually. So how do we make that transition as efficient as possible? And if you're in a business that's seen a significant decline, or if you've got a portfolio that's seen a significant decline, now markets rebounded pretty quickly, but part of the early conversations that I was having was around freezing investment portfolios at a lower value so that you could transition that future growth to children. Now a lot of the conversations transition to owner-managed businesses and looking at, okay, was your business severely impacted by COVID? The examples, a restaurant that's been shut down and closed right out, they're not not seeing the growth or the revenue. I mean, maybe it's not as lucrative a business, but any business that's seen a significant decline, we have an opportunity to improve the tax structure. Maybe the tax structure wasn't set up as efficiently as it could have been at the outset, or maybe the structure was good, but it was frozen at a very high value, and there's an opportunity to perform what's called a thaw. So take those preferred shares that are locking up value in your corporation, exchange them for common shares, let that value drop, and then freeze in at a lower amount. Even if you're young and the structure wasn't terribly efficient at the start, I work with a number of tech startups that we're having these conversations where the business is down significantly, and we've got the opportunity to fix the tax structure that was set up, or the ownership structure that was set up at the outset, to introduce a family trust, introduce other shareholders at a lower value so that we can have some of that upswing in value attributed to other people, maximize access to the lifetime capital gains exemption, in some cases introduce a trust. So it's really around optimizing the structure with a lower price tag. And then for people that are closer to retirement, we're having a conversation around locking in estate tax liability. So if we're saying, okay, we've got a depressed value of your estate, a depressed value of your business, let's lock in at that number. We can calculate what your estate tax liability will be, and then we can purchase an insurance policy on it, and we can run the numbers, or you can purchase the insurance policy in a corporation. We can run the numbers, we can figure out exactly what capital dividend account balance is. We can set up some more sophisticated planning around insurance shares to make sure that we're making the most of the current opportunity, and allowing for the maximum wealth to transition to your children, and keep as much money in your family's pockets. So that's really the conversation that I'm having with my clients, Peter.
It's been an apprehensive time for sure. What kind of questions are you getting from your clients when you sit down and have a coffee?
A lot of it's around the stimulus, and we're starting to see stimulus fatigue. The most recent announcements come out, and people are starting to wonder, is any of it for them? And I think we really need to look beyond the stimulus. A lot of the businesses that can make the most out of this opportunity are the ones that are going to survive beyond the pandemic. If you're really questioning whether your business is going to be around, then the tax opportunities or the tax planning opportunities are limited. But it's really around the best conversations are the ones with the businesses that are seizing opportunities in a down market. So making acquisitions. I have a number of clients that are going through fairly aggressive growth through acquiring clients over the last 6 months. And those are the ones that I think are going to have the strongest 2020 through 2030 growth.
Okay. If you had a crystal ball again, and you get through stimulus conversation and you get some planning, what do you see then are some of the future issues that we may be heading towards in terms of tax efficient planning, tax effective planning?
I mean, there's only one way to fund stimulus at the rate that it's being handed out right now, and it's through increased taxes. So setting up tax efficient structures, I don't want to step on Trevor's toes too much, but there are some very good very, very tax efficient things that you can do with different forms of insurance policies to get cash out of a corporation. And I think that's the planning that people should be looking at right now, is how do we set ourselves up for the 2021 and 2022 tax hikes? Because I know who's going to be paying the bill, and it's likely not a lot of the CERB recipients.
Any thoughts from our esteemed, any questions from our esteemed panelists for Greg on the CA side of things?
Look, a comment. I think that if we're wondering when the next election is, it's probably before everyone who's getting CERB realizes that it's taxable. But I do agree with Greg completely. I talk to clients all the time. My phone is ringing off the hook, as you know, Peter, because I'm working with guys like yourself. And what I'm finding is we don't know what's on the other side of the hill, but anybody who's in business or professional practice knows that it isn't going to be good for them.
I would certainly echo that. The business owners that I'm meeting through virtual events similar to this, through industry conventions that have gone virtual, it's exactly that. This pandemic has amplified the very best businesses are mopping the floor with the weak and wounded, and those who had debt are, despite the low interest rates, are really vulnerable to be aggregated.
All right. Well, thank you, Greg. We may come back to some other tax-related questions. Trevor, you missed my my introduction.
No, I heard it. I was just offline, and I don't live in Hamilton. I vociferously must state that I live in Ancaster. So
I'm just used to going to McMaster University.
there you go. It's down the hill from us.
Trevor, you've had quite a career and have been doing work across the country and some pretty in-depth casework. Talk to us a bit about what you're seeing then across the country when it comes to planning and what the issues are.
The vast majority of people's trepidation and fear. But as Greg said, there are massive opportunities in this area. I've got a number of clients right now who are looking at the fact that they've been good savers, but they're in the wrong industry temporarily. And so they've got depressed asset values. So they see the opportunity. There's a lot of people also who they're getting fed up. And they say, how much, the goose that lays the golden egg can only, be pillaged so often. And you're starting to see people look at planning strategies that 2 years ago we wouldn't have considered. I don't want to say they're aggressive. They're just something they didn't consider before. Probably not something we're going to talk about today. But the wholesale, it's sort of the omnibus feeling I'm getting from people I talk to is, they're sick and tired of paying 50% plus, and now the great unwashed would like 60 or 70 or something like that, because the handouts in their mind have to continue. In some degree, you're getting the Atlas Shrugged model, but it's time for folks like everyone on this call, because we have the ability and the wherewithal and to be able to go to people and say, look, you don't have to tolerate this. We're not saying throw out the rule book. You can stay inside the lines. But there are sensible and prudent means of saving tax now and in the future. And I think that's resonating across the country, regardless of region. Anybody who's got a spark of entrepreneurial DNA to them, or professionals in practice.
I think Greg touched on it. When it comes to the banks, you and we've been talking a bit about that and done some work in that area recently, Trevor. Where do they fit in? Because, low interest rates certainly obviously are promoting housing purchases and things like that, and backyard pools. Where do you see it fitting in the real strategic planning?
As an entrepreneur, they're a necessary evil, aren't they? It's good to have friends in the banks. They can facilitate a lot. They can also say no, and when they do so, they will do with sudden and ironclad resolution, and that'll have to happen, because at some point there's going to be, as Tom says, there's a bunch of companies that have too much debt. They're going to have to make their decision. Right now, banking is as close as you can get as a no risk return. The government has basically guaranteed their outcome, and that's fine. And the Canadian Economic Foundation has forever been based upon our giant banks. That's fine. So making a friend of them is far better than not. And certainly, given that what we do, Peter, in the world of, if we get into insurance strategies where we want to utilize the bank's money rather than the entrepreneur or professional's own money, you better have them on side. And they're certainly they're quite gregariously excited about that marketplace. So the banks, as I said, necessary evil, friend, however you want to look at it. That's sort of an ideological perspective, but they're integral to what we're going to do in terms of tax planning for the next 36 months for sure.
Can you expand a little bit on, as we were chatting about our plan today, a little bit of expansion on immediate finance? arrangement?
Sure. And I mean, I got to tell you, I mean, I run into this all the time. And as you know, you and I have worked on these things. I have several cases in the teens across the country right now, and it's not for everybody. And unfortunately, in the insurance business, it's full of, as I've said from time to time, or all the time, practitioners of felt financial alchemy who try to, with a pamphlet, put people into things they shouldn't be. You have to first and foremost have an understanding and a good gut tolerance of debt. But immediate finance works tremendously well. And I mean, it's based on the old London Life Freedom 55 model. All it is basically, instead of borrowing at the back end of the policy, once you've created all the cash value, you create a policy with a bunch of cash value at the beginning, collaterally assign or assigns collateral the policy, and then draw back the loan proceeds, either equivalent to the cash value or the whole premium, and replace the money you would have otherwise put into the policy. So I always ask people 4 questions, and it's part of my 15 to 20 page verbiage in the memo that I put together. But basically, do you need the policy? So that's the first and foremost thing. Do you need the coverage? And it's not, people, there's a negative connotation to insurance. Don't think of it as insurance. Basically, it does 2 things. It provides liquidity to take care of the tax bill when you shuffle off the mortal coil. And secondly, it's a giant financial accordion folder that allows you to, save money in an tax exempt fashion. So the big question is why? Then can you afford it? Which is a respect for cash value. People would rather put their money into something else than a policy. And then that's the third question. Could you get a better return? Now, if you ask some people, and usually it's some medical doctors and things like that who are lovely people but don't understand economics, they say, oh, sure, I can. But if you ask an entrepreneur who understands what's the return in their business, they'll usually say, yes, I can, and I know it. And then the fourth question is, what's your gut sense? What's your real comfort with debt? Because as you know, I worked for actuaries for years, and they'll never give you a long-term estimate as to what interest rates are. Maybe they stay here for a while. Maybe we become Weimar Germany for all I know. But at the end of the day, it's a variable we can't understand. So that has to be built into the presentation so that people understand there are some risks here. But if they're okay with those things, then immediate finance makes a lot of sense for the right client.
And you mentioned your time in the actuarial world. Can you shed some light? Are you seeing any other strategies come back at all? We talked about CPA,
having and to toot my own horn with the good people at GBL, we set up over 2,200 IPPs during my 12-year tenure there, more than anybody in the country. So I still get calls all the time about them. Now, I've sort of filtered my response to it in that when I was there, hey, that was what was for sale, so everyone needed an IPP. Now I approach it more from a pure tax perspective, which is, and also planning. So there's cases where you're going to get people who just can't save for the life of them. So an IPP is a great thing, and it makes sense because it does result in something tangible, predictable, all those things. But for your entrepreneur, I measure it in terms of tax, in the sense that what's the deduction rate you're going to get? Are you paying what we call GRIP rate, which is 26.7% in Ontario? Are you paying the small business rate? Do you have, with the contribution that you make, usually through past service, so for a 63-year-old, if they're, husband, wife going in, I can probably get you $1 million deduction. Will that create the deduction you need and perhaps the ability to create a loss to carry back and get back taxes you paid in previous years? If those things line up, then my accountant colleagues and I say, yeah, I think we look at it. I'm certainly getting a lot of calls on retirement compensation arrangements, and that might coincide with the fact that it's free agency time in the NHL, but it's all very flexible vehicle. People are looking at, it goes to, and as I've written about this before, it's what kind of tax relief do you need? Do you need a deduction, or do we need to do retained earning strategies? If it's the latter, then we're looking at things like corporate insured retirement plans and estate bonds and IFAs and all that kind of stuff, or CCPC planning and all that kind of stuff. If it's the former, if you need a deduction, if you need to pull down the earnings of that company or the profit of that company to get to the small business rates, then we're back into the world of IPPs and RCAs, and they're still relevant, but there's only 13 or 14,000 of them. And that's after they've been around since 1991. So yeah, they have guts and they have legs, but in the right situations.
and guys, any thoughts? I mean, back to kind of what I asked Greg then, if you were to put it into a mixing bowl, in this interesting time as families look ahead, are you seeing more consideration for the estate, or what's beating the drum generally when you get into your business case work? Trevor?
Well, I would absolutely say there's been an absolute uptick in that kind of activity, because going right back to your opening piece of data, which is there's $1 trillion, 755 billion if you're using some of the bank data, that is going to transition over the next 10 years. $205 million was inherited today in this country. So we know that there are probably on this call high net worth, wealthy Canadians who have surplus capital, and there has never really been, and this is a generalization, a lot of urgency to figure out how to transition that wealth efficiently, tax efficiently, or put the tax aside, just transitioning that wealth transparently. Like, it's just kind of an anathema to our culture. And we know that because the courts are full of families litigating. But I think there's been a shift. I really believe in the last 6 months with this COVID, where wealthy, elderly Canadians are looking to their adult children to start to have conversations around their healthcare. Like, if I get COVID, I need you to weigh in, and here's my healthcare director, here's my power of attorney. Like, that stuff has just never happened. And I just think it's a fascinating time, because I think that's leading to way more and way better intergenerational conversations about the kinds of things that Greg and Trevor have just kind of scratched the surface on. That's new. We've always kind of, dealt with these kind of things in silos. Like, don't involve the next generation. These are kind of like surprises that are emerged after someone has died, right? I think the really big takeaway now is we're going to get at better solutions, more family involvement with advisors at the center, designing and having these conversations. It's exciting.
As Tom's pounded the table for years, the conversations that go on in a family about what's going to happen to the founding generation and after that, the subsequent years, is absolutely exponentially exploded in the last 6 to 8 months. Absolutely. So people need to know. They're talking about it. What's going to happen? What's on the other side of the hill? Well, we don't know, but we know that we can take action that's tried and true. But the key is communication, that mom and dad talk to the kids about what's going to happen next, or the grandkids. Who's up to actually taking over the business, or who thinks they're carrying their own cross? They have to have that conversation.
And the thing that I'm starting to see more in maybe the last few weeks is more of those conversations being had with advisors. I had a meeting this morning, banker, insurance, lawyer, an accountant, sitting down with the founder and his children and talking about transition. So that's, those are the conversations that need to be had. And it's a much more efficient conversation when everyone's looped in and everyone's sitting at the same table, rather than tossing back examples back and forth in draft documents.
Yeah, and I would agree. And that's the most exciting part for the work that we're doing in our office, is when we can get around a table and really share some honest dialogue instead of working in silos, which is typically kind of our industry. And hopefully we'll see more of that now then.
Peter, I can tell you, in the worst example that I have ever witnessed, I was approached by a family business, second gen. These were two brothers that ran a family restaurant chain. You would certainly know who they are. I'll protect the confidentiality of the family, but these two boys received an unsolicited offer to sell the restaurant chain, and they were so excited because it was at a huge multiple. This is about a couple of years ago, and they took the news to their father and said, "You are not going to believe this. There's an M&A firm that's aggregating, and we can get this great industry multiple, beating the industry multiple, and we want to pull the ripcord." And Dad said, "Well, actually, over my dead body." And they're like, "Well, we're not actually here for permission. We're going to do this deal." And he said, "Absolutely not. I will never allow it." Dad had done a freeze, and the boys never really quite understood that they got growth shares. They didn't get voting shares. And for like 15, 20 years, they were growing a business that they thought they controlled. And you want to talk about a family that never really recovered from that revelation. That would be the poster child. Yeah, Dad just refused. Dad just absolutely refused to have his legacy sold.
Yeah.
And that was primarily because it was tax efficient, but the people impacted, the next gens, really did not understand at all what was going on.
Interesting. Okay, Trevor, hopefully you can jump in any time here as we go forward, but any closing thoughts then from kind of what your mixing bowl's been telling you lately? Anything we should keep an eye out, or what family businesses are striving for?
Well, I mean, they all know that they're in the crosshairs, right? So you hear as to, there's a good, well-known tax fellow in Calgary, and he and I try to address each other. He wears checkers and I dress like, depending on your ideology, Churchill or Jacques Parizeau. We banter it back and forth as to what we think is coming. Wealth tax get bandied around because, as Rex Murphy refers to Jagmeet Singh as the hood ornament of the liberal juggernaut, he's demanding that. I mean, the problem, I don't say it's easily fixed, but it requires a fundamental change in the way they look at taxation. I think the problem is somewhat dealt with by getting back some of the money they've lent out, which will happen. But by, for instance, going to a 20% HST for 2 or 3 years. It'll never happen because the voter that puts the government in power would never tolerate it. So what are they looking at? They're going to come after everybody on this call. How do they do it? Inclusion rate increase. Once it goes to 75%, you have a 40% effective capital gains rate. And remember this, the great class enemy in this country is the 1%. What you have to tell, and I tell clients all the time, though you think yourself, wonderfully middle class, at that one moment, that last moment, that the crossover from corporeal to temporal, you, my friend, will be in the 1%, and they are ready for you. So we have to be aware of that. I think they're going to tighten up in a surgical fashion on certain anti-avoidance measures. I think you'll see the capital gain stripping go the way of the dodo. I don't think they're going to change insurance. Everyone who says, "Oh, they're going to get rid of the capital dividend account," no, they won't. They'll go after aggressive practice, and they're already doing it. I talk to tax people all the time. I have friends at CRA. They tell you, "Yeah, we're going after this, this, and this." The thing I'm worried about is, they could go after some wholesale tax changes like principal residence exemption. Would they ever get rid of it? No. But if they said, okay, so Justin and his much smarter advisors are sitting there saying, well, what's the average liberal voter's house worth? Well, Peter, what's the average house worth in London, middle class home?
It's hard to keep up these days. I think it's up 30% over last year, Trevor.
So it's $1 million?
Around I'd say 500,000 to 600,000.
Okay, so I would say if you look at Toronto and Vancouver, your middle class home's probably 1.5, Calgary's probably 1.2. Who knows, right? They take a cross section and they say, listen, we're going to exempt everything, let's say under $800,000 at $1 million, and everything over that now fully taxable. They could sneak that in and they could sell that as only the 1% have $2 million homes or $3 million homes or 1.51%, $1 million homes. That kind of insidious tax planning is possible. What they should be doing is a Carter Commission 2.0. They're not going to do it. They're also going to continue to squeeze on integration. They want people not to take dividends, and I defy anyone. I mean, Greg can probably be the best explaining to the TOSI rules to us. I've just spent, wrote a paper for a conference I'm presenting at soon, and I just spent, reading 200-300 pages on this, and I couldn't tell you other than a brief summary of what it is. It's Byzantine as hell. So they're trying to drive people down the route of taking income, and so it's transparent and they can tax it. Only more of that's going to come. Registered plans. Hey, they love registered plans. They should double the RSP limit. Why? Because they get it at the end. They get to tax it as income. Really, the only whole-scale, large-scale, widely acceptable, and widely accessible tax shelter in this country, and I don't want to sound like I'm pitching, is permanent life insurance. That's it. So that everyone in this call knows that when we're having an estate planning call, a corporate tax planning call, with clients or a meeting with clients, we're bringing this forward not as a product. There's too many people pushing product, but we're bringing it forward as the only tangible solution with regards to understandable and prudent planning. And that I don't think changes.
Okay, thank you. Well, let's segue over to Dr. Tom. Thank you for joining us today. I guess as we start this, our conversation, we've had some really good insight. What's your, you've been talking across the country and also in the States and I guess across the globe. Are businesses, business families and families generally in good shape today?
Well, actually, they're exhausted. I think that was the word that was used. They're exhausted. They've been beat on. The federal government, starting with the attack on passive income. I mean, small, medium-sized business owners have been put on. They have been called tax cheats. They've been belittled. They've been used in wedge politics. They're exhausted. And my great fear is that the aspirational quality that has driven this country to extraordinary heights of wealth creation is the great crime here. There is, when notionally we believe that the best careers for our children are federal government or provincial government jobs because they've got defined pension plans, we are going to be in a generational world of hurt, which really is kind of my space. I'm talking about the movement of wealth between generations. And I just think that there has been so many recent examples in the last 5 years where wealthy families are saying to their children, either relocate or certainly, I don't know, I don't think I want you in this firm. I don't think I want you to continue this family business, because this idea of creating wealth and reinvesting into our retained earnings and concentrating our wealth in a stock, the family business, is not going to work. It just doesn't feel like it is a safe strategy. And so I don't know. I think we're seeing a wholesale movement of wealthy Canadians moving from operating businesses to becoming broadly held holding companies where they're investing in, sadly, U.S. firms. The great, and I'm including myself here, we sold to a German firm, but really it was the American subsidiary that ended up operating our plastics manufacturing operation. But that, I just think that is just going to continue, but at an accelerated pace. Yep, start it, grow it, scale it. Don't continue it because it is so punitive to transition operating businesses to the next generation. Mm-hmm. Unless you start to engage in some of the strategies that Trevor and Greg and yourself are working on. It is this whole idea of just dying and leaving your business in your will to your surviving spouse. And then when they die, the shares come down to all the kids in equal amounts. Like that is going to be like lamb to the slaughter. That is not going to work anymore. So I go right back to where I started with this pandemic. It is happening already, but people are leaning and searching for a different kind of advisor that has really understands the technical solutions that are in place to protect the family wealth that has already been made. Never mind making more money. If you can just hang on to what you've got for the next 3 to 5 years, you are going to be thrilled with you should just be thrilled with your planning. We are heading into choppy waters, big time.
Tom, to follow up on that, to add to that, not only advisors who have the smarts to know how to do it, I say it's almost like a religious vocation to believe in the entrepreneurial spirit and the holy mission of keeping the hands out, the wealth out of the hands of government, because they will squander it. We know that. And I think the average Canadian, certainly the average Canadian business owner and professional gets that. And what I'm seeing day after day is not just a capital flight from this country, but a intellectual capital flight. They are leaving. Capital is agnostic. And though we all love this country, a lot of people are finally saying, I'm done with it. Turn the lights off. I'm leaving.
I have a brother who lives in the U.S. He ain't coming back.
My wife is a U.S. citizen. I said, "What state do you want to live in?" She said, "Vermont." I said, "That's wrong. I'm made for Texas. I have the hat for it."
Yeah, no, we all have these stories, and it's listen. I've spoken in 26 countries, and I travel. I'm a proud Canadian, and it breaks my bloody heart.
Yeah.
To be talking like this. It breaks my heart. I hope one day there will be a time where we can come back and we can build this country, and that entrepreneurs, those who are willing to risk their ideas and their capital to build something that is bigger than themselves and their family, call it your community or your country. Like, no one is talking in that way. No one is expounding the virtues of personal responsibility and personal accountability and entrepreneurship and risk taking. I don't hear anyone talk about it.
No, they don't. They don't talk about it at all. And I mean, it's not woke. My family came to Quebec or New France in 1632. We got there before the Mohawks did, which is politically incorrect to say, but is true. And you're absolutely correct. Nobody is talking about the values that made the country. Stoicism. You know, Canadians, you know, we apologize and line up as a national sport, but now it's none of that. No one celebrates profit. We get this Ken doll running the country who has kumbaya moments and strategic crying sessions, and he is absolutely pillaging the country, but for the oligarchs who actually run it. I mean, when I talk about family businesses, the most successful businesses in this country are family businesses. We know the names, and none of them are attending on this call.
You can be sure of it.
Tom, you talked about transitioning your business, and you've written the book Every Family's Business, which I'm not sure how old the book is now, but you talk about 12 questions. They've obviously been important in your talks, and you've had some interesting dialogue. Can you expand a little bit on when we're having this conversation about protection and transition, really what the 12 questions kind of cover, or what you'd like to shed some light into that area?
Yeah, sure. I mean, really what we've done over the course of 100 years, starting with my great-grandfather who had a tire distribution business in the 1920s. That business was sold in the 40s. My grandfather inherited, started a chemical manufacturing business. Father worked in that business. He didn't love it. That business got sold. The wealth got transitioned. My father starts a plastic company. That's a company I joined. That's the company I ran for 8 years. That's the company that we sold in 2007. Like 4 times we've started, scaled, involved family, but sold. We don't gift our businesses to our kids. We are asking our kids to risk capital, including family money. Like, don't get me wrong, we gift wealth to the next generation, and then we say, hey, do you love this business that I've started enough to just hand that money that I just gave you right back to me? And in our family over 100 years, we don't do it. Like, at some point, we're looking at the risks to those businesses, and we're saying, now there's a better opportunity over there. And so I now have a publishing company. I have 2 kids, 27, 25. I've asked them if they want to risk their capital, some gifted money, and buy my publishing company. They're like, no, we're good. Like, it's another one that will be sold. And that was really the genesis of Every Family's Business. It's a very different message, right? Whereas we are wedded to this idea that we measure the success of a family business in generations, we come at it differently, and we understand that a business has a shelf life, and our job is to find out where that business is in its life cycle. And the only way that I know how to do that is to ask someone to risk their capital and then buy it. And if everyone says no, if employees say no, family says no, they don't want to buy it, key competitors don't want to buy it, private equity don't want to buy it, where do you think that business is in its life cycle? Yeah, you miss your freshness date. So, like, really, that is a question, really is the job of ownership, to spend time on their ownership and to keep constantly, every week, every month, every year that they are in business, constantly saying, what's changing around me? What is going to affect the value of this business? And I think when we get resolution and clarity around that question, those are those moments where business owners go, I need help. I need help with my planning. I don't have a tax plan. I've got surplus capital. We had $1 retained earnings for every $2 of sales. We didn't have those things that you've been touching on. We left it way too late. We were underinsured. There are too many business owners who are so, I just think distracted by their operational profits that they lose sight of the fact, and we've been reminded in the last 6 months, how things can change around us so quickly that shift the ground that we're operating on and have profound impacts on our value. And I just think that that's why this is an interesting time, because I think we're going to get to where I want to take business owners, which is straight into the arms of professionals like yourself who have been waiting for this day. Like I just don't feel like you have to make the case the way you used to in the past. Like now everyone knows that this idea of a 70-year-old business founder concentrating 80% of their wealth in one illiquid stock without a tax plan, a transition plan, is insane, especially in a country where we have demonized risk takers and business owners. Like that's just crazy. And I just think we're entering into the sweetest spot for business owners, because not only do I have to write books and give speeches and give business owners permission to take care of themselves, now they understand that no one's coming through that door to do that except you guys. You guys are in the wealth protection business. You guys are in the business of saving families from this carnage that is just right around the corner. We know it. We smell it. It's in the data. We know they're coming. We know they're coming for us. And I just think, like, now to be nimble, is the time to take action. No more talking, no more thinking about it. Book a meeting with you guys. Seriously, don't call me. I just write and speak. You guys are way smarter, and you guys are doing the work in the trenches. Stop thinking, stop talking, start doing.
And obviously, a lot of the planning gets turned on or off by proper will planning. So what can you comment on that? Because your other book is, Will and Wisdom.
Yeah, for sure. We got 12.5 million Canadians without a will. We got half of all business owners in this country without a will. You want to talk about a calamity. This estate planning dysfunction is much like fraud, right? When someone gets duped by a fraudster, they're so embarrassed by what they did. They don't tell the story so that others in their family or in their community don't make the same mistake. You know what we do in estate planning? When a parent dies without a will, we're so embarrassed that for, $1,500, we could have saved, $15 million. We're so embarrassed by the insanity of not doing the basics that we're ashamed, and we don't tell those stories, and it continues. Family systems theory suggests that if our parents didn't have wills, didn't have family meetings, they didn't put a real premium on preparing heirs and involving them in the kinds of tax planning conversations that you folks are really great at designing. If our parents didn't do that, there's a very good chance that the people on this call, they're not going to do it. What I'm really saying is, this is a call to action for business owners to break that cycle. If you've created significant wealth, and maybe you're the first person in your family to really create surplus capital, that comes with a significant duty and responsibility to protect your family, to transition that wealth with clarity and purpose and with lots of communication, with lots of involvement in advisors, so that when you die, and you will, the family will go, well, we know what to do. We've had this dress rehearsal conversation with our advisors. We know who to call. We know this day was coming, and everything is going to be fine because we have copies of our parents' wills. We know who the executor is. We've got a backup executor. We know the power of attorney and the backup power of attorney is. We are not going to be ripping drywall off our parents' house looking for a document that we think exists, but we're not really sure. I mean, this is what I'm talking about. This is not sophisticated planning. I'm talking about the basics that is not being done. Before I'm overly hard on the people who are listening, don't feel bad, right? Bobby Kennedy, when he was assassinated in Los Angeles in 1968, right? Good news, he had a will. Guess who his executor was? Yeah, his brother, assassinated 5 years earlier. They did not have Peter Richards advising them, because if they did, that will would have been updated. There would have been there would have been an executor, that document. I'll tell you, whoever was advising the Kennedys, I guarantee they're not advising them now. There's no way. The best advisors are making estate planning a priority. They understand the impact.
Well, I must say one of the proudest moments I've had in our work, it was when I was invited by a family to help chair a family governance meeting. We've had 3 of them, and it's been really interesting to see the interaction with the kids, and as you say, the documentation and the understanding. There are a wide variety of ages, but certainly the youngster heading to university had a lot of great questions, and I commend that family for going to that step of, there's a lot of moving parts. We've got to understand how this thing could come apart tomorrow.
And Peter, to echo what Tom was saying, the other documents that are critical. So a good buddy of mine who practices law and does some estate work from time to time says, basically your will should cover your Elvis plates. You want as much to travel outside the estate as possible. Ontario's Estate Administration Act is a disaster. The secondary will is probably more important in most cases than the primary will. And I would say as a corporate guy that the shareholders agreement better be tight, because I read all kinds of them and they're disasters most of the time. They tie the hands of the company, or they're vague and non-enforceable. When we get into discussions of post-mortem planning, which is avoiding double taxation, where we actually can, with planning, and Greg talked about some of the things like insurance shares, and we do this all the time, where we can get down, a tax, we can do in certain cases down to 0 tax, but a company of a more robust size, we're routinely getting the actual tax result down to noticeably below capital gains rates. But it's got to be done with the right drafting. It's got to be done with the understanding of all those involved, that this is what's going to happen, necessary flexibility built in, but those constating documents have to be there and they have to be regularly reviewed. So yes, guess what? Once you make money, you get compliance costs. So lawyers and accountants do well, but hopefully they're delivering.
And Trevor, wouldn't you agree that really controlling the clock, like if you have surplus capital, you're a successful business owner, controlling the clock, doing this when you don't have to do it, when no one's requesting you do that, that's the time to do it. Not everyone will be as fortunate as Cecil Harris, who has the distinction of writing the shortest will in Canada. I don't know if you know this, but he died under his tractor in a field in the prairies, right? And he knew he was dying. He was bleeding out, and he pulls out a penknife out of his pocket and he carves into the fender of his tractor. I leave everything to the wife. They cut that fender off. It was submitted into probate. Like, that is not going to happen for a lot of people on this call. We don't know when we're going to die.
No.
Control the clock, use it to your advantage, be the smartest guy in the room, and get this stuff done and communicate it and build that plan with your advisors and your family's involvement.
Having a chief of staff, like someone like Peter, who can attend those meetings, facilitate an objective discussion, but bring forward these things that they have to be updated. I mean, I'm slowly getting through the book I'm writing on life cycle planning for a business. You don't do this when they're about to shuffle off the mortal coil. You can. I mean, it gets done all the time, but it's best to do it once that company, once that professional practice has turned the corner from survival to profitability and tax management. So usually in their 30s or 40s, now it's time to talk about what happens next. And yeah, you're not going to shuffle off the mortal coil for 40 or 50 years, but put the framework in place. It's going to get updated all the time, but building the discipline to review those documents, to understand how things work, to be apprised of, not at a high level, but at a reasonable level of how tax works. Those are things that every entrepreneur has, because I assure you that the silent partner that we all have, which is CRA, is not there to make sure that the profitability of the company and the tax minimization strategies work exceptionally well. Quite the opposite.
Okay, well, I'm gonna put my my CBC national TV host hat on here. We got,
and no one will be watching you, Peter.
Parting shots. Let's go around the round table. Greg, we're approaching 45.
Yeah, I think.
Any insights from today or things you want to leave?
One of the things you said, Tom, kind of struck a chord. We don't talk about the bad ones. And relatively early in my career, I was working on the cleanup after a taxpayer literally was hit by a bus, and $30 million estate, no will, no shareholders agreement, no tax planning, nothing. Literally handed a check or it was a draft. I took the draft and delivered it to the CRA because you could still do that back then. $6.5 million bank draft handed over to the CRA, and that the feeling of actually giving the CRA millions of this guy's money, that, you know, with better planning, like Trevor said, in that situation, we could probably get very close to 0%.
Yeah.
Trevor?
First of all, I'd never likely be invited on the CBC, but
Hey, let's pretend we're a sports desk or something like that.
okay, well, go Habs. The businesses, our professional practices are expressions of our lives. They're expressions of every endeavor that we consider. They are as important as our families. Usually our families are intertwined in them. We owe a duty to those enterprises, as we do to our families, to do the right thing, to plan, to discuss. We have to understand that we are at a seminal moment, an existential moment in the life of this country. Never in my 53 years did I see or believe that we would see policy promulgated on the basis of class envy. Entrepreneurs need to understand the government is not in your corner, quite the opposite, that only you can decide to take matters into your hands and retain the right people to provide you a very prudent, we're not talking about risky, a prudent, understandable, transparent plan to defend against what they want to do. We have to ask certain questions. What do you want to happen to your money? I cannot remove Justin Trudeau as your primary creditor. I could beat him in a charitable fight if he wants to take me on, but I cannot remove him. I can do it with a charity. I can do it with planning. You don't have to pay 40 or 53 or 48 or 53.53% by any means, or double taxation. You can pay noticeably less in a prudent fashion by planning, by gaming this stuff through, by working through the numbers, involving the advisory team, and putting forth a comprehensive, flexible plan that works. But waiting for the government to wake up and say, we need to save entrepreneurs, my friends, it's not going to happen. You have to act now.
Tom?
Well, Peter, you will know that I'm a big fan of beginning with the end in mind, and we all are going to die, and we're all going to leave something. And I think as the more years that I spend speaking with business owners, wherever I'm speaking, wherever country, it's always the same thing. There is a moment in a business owner's life where they kind of have an awakening, and they understand that they really won't be remembered for their business. I mean, let me ask you a question. Who was the founder of Coca-Cola? I can speak in front of 5,000 people. It's crickets. No one knows. No one even Googles it. No one cares. That's the third most valuable consumer brand in the world. The reality is we are remembered first and foremost by our family. And I think when we have the courage, and even though it's counter to our own personal experience, to involve our children with our advisors and building really smart transition plans of wealth. How we leave our wealth is actually as important as what we leave and how much we leave and where we leave it. And I think when parents invest that energy and creativity and those ideas to prepare next gens, their heirs, their family, they actually are going to be remembered fondly, frequently. And I just think that is, often we just ignore that. We just fail to understand that our family is at the center of wealth. It's always been, like the wealthy on this call who have bought their boats and their cars and their houses and their cottage, or maybe getting at that stage of life where they're actually getting rid of stuff because we understand that that's work. They're at a moment in time, an inflection point where they're understanding that their family is important because it is going to be family who's going to be stepping up and providing oversight of long-term care. It's all the same conversation: tax strategy, planning, efficient transition to family wealth, and late in life care. It's the same conversation. And I just think it's the exceptional advisors, and I'm going to lump you in, Peter, into that very small community in this country that is investing in my books and my time to deliver this message. You think the 33,000 advisors in this country are doing this with me? Very few get it. Not every advisor are built the same. I know you've carved out a very special small niche in your city. in your market. And I just think my call to action for the folks listening is enough listening, enough thinking. Please, this is not business as usual, as you've just heard. Book a meeting, get going. They're coming hard, and they're coming unrelentingly for your money, big time. So let me wrap up and say thank you. Thank you for this opportunity.
All right, well, thank you, gentlemen. As maybe just a bit of housekeeping, see a couple of chats came in. So if they are questions, I guess what we'll do, guys, is I'll field them and we'll make sure we get the answers out, if that's fair. We didn't get to them on the call today. This has been really an enjoyable time and interesting to do our first, shall we say, Zoom interactive conversations. Hopefully we can do it again and keep these topics flowing. For everybody who's attended and who gets a chance to see this, if you want more information, let us know. We'll direct it. More technical detail on any strategy, please let us know. Certainly conversations, and for Dr. Tom Deans, if you'd like a copy of his Willing Wisdom book for every family's business, or even the index, which you have now, I believe everyone should have a copy of that. Get that out to your friends and family. Please contact us, and I guess on behalf of everybody else in our company, Daryl and Jeff and our colleagues, thank you very much for attending, and guys, thanks very much for your time this afternoon.
Thank you, Walt.
Thanks, guys.
Okay, bye for now.